Is your portfolio ready for this market shift? And the market shift that I'm talking about is multifold. It involves AI, it involves quantum, it involves lower interest rates. There's so many different factors going into this market shift. Articles are being written just as we speak about AI being in a bubble. AI can't be sustained going forward because the spend on AI is going to outstrip the revenue generated by AI. There are quantum computing stocks that are just gone up so much in the past few months, even in the past month, and now they're trailing off and peaking and coming back down. And you see the Fed Watch tool and you see that there's almost 100% probability of a cut in October and probably going forward lowering after that. So we're heading into a lower interest rate, possibly higher inflation, and easier monetary policy going forward. That is all to say, what should you do with your portfolio? How should you build your portfolio to withstand any type of shock that happens in the market? In this video, I'm going to go through my portfolio and how I'm building that and show you how I want to build my ideal portfolio. If you like this content, please like and subscribe, and let's get straight into it. So this is the public portfolio composition as of this video. And so I have BABA at about 1%, ASML at 2.4%, HCC, Warrior Met Coal, at 15.5%, Google at 26.2%, Meta at 37.8%, and Amazon at 16.6%. And Tidewater is a fraction of the whole, and it's less than 1%. Now, if I was to group these companies into what they are by category, then you would have semiconductor equipment and manufacturing. You would have hyperscaling and cloud computing. In the semiconductor manufacturing and equipment space, you have ASML. And ASML is the monopoly in that space. These machines cost $400 to $500 million a piece. So when a fabrication company like TSMC buys one of these machines, it is an investment into just that technology, to the knowledge, to the expertise that ASML provides in creating this masterpiece. And you may be wondering, why am I promoting ASML as a AI resilient stock, AI bubble resilient stock? The reason is multifold again. And one of the reasons is that bubbles can stay bubbles for a long time, for years and years and years. In that time, you don't want to miss all of this upside in a monopoly-like stock like ASML. ASML is who every chip fabrication company goes to get the leading tech in chip fabrication. So there's still a long way to go in the growth of this company as well. The total addressable market for AI has not been reached. And you can see it in articles talking about compute and the need for compute, and that the world is falling short of compute. So you can see that, and the only way that compute gets made or created is to make the chips. And the only way those chips get made is through an ASML machine. So this is a great play for at least a few years into the future, while this bubble still grows and expands. Now, in the hyperscaler, cloud computing, and other services group is Google, BABA, Meta, and Amazon. These are vast companies, and I will just generally say why they're good plays for this new environment. Google, Amazon, Meta, and BABA have been around before AI. They've been generating revenues from all of their services. They're in so many different pots that AI has just been thrown into the mix of all of those different pots. Google, for example, has been doing quantum chips. They have Waymo. They have YouTube, where I'm recording this. They have so many pieces of the puzzle. Amazon is the exact same way. They got Zoox. They got their huge logistics business. Also, both Google and Amazon have cloud platforms, AWS and GCP. Meta is more than 90% of Meta's revenues comes from advertising. And that was true even before AI. So what AI has done is just introduced better inferencing, better inference ads, better targeting for those ads. And so it just made it a product that was good better. So they will continue to operate even if there was no AI. And then Baba is very much similar to Amazon and Google, where they have a huge cloud platform. They have a huge e-commerce platform in Alibaba. They have so many other segments and pieces of the puzzle that they're a conglomerate. They have so many things that they are getting revenues from. So these companies are hard to disrupt because they are just so vast and so big. So even in an AI bubble, which, like I said, could take years to actually pop, these companies will have immense growth up to that time. So you don't really want to miss out on that type of growth. These companies are not speculative plays. Don't get me wrong. There are small cap AI startups that are speculative in nature. These are tried and true mega cap tech names that have multi-trillion-dollar valuations. So that's why I'm not worried about these companies in the environment that I described before. Another reason that I'm not worried about these names is that these mega cap tech names plan to spend more than $300 billion in 2025 as the AI race intensifies. So they're really competing against each other. But all this money is coming from their operations. Their own businesses generate this money. Now, if that changes, that could change in the future. And if more of these companies are taking more and more leverage or debt to pay for these AI spend where there is no return, that could be the flip side of the coin where there could be more trouble ahead and it's more likely that it becomes a bubble. Once they do start to see revenue and earnings increases from this AI capex spend, and if it does catch up, all of this AI spend could be justified. And in addition to the spend that they're doing on AI, a lot of these tech names have been streamlining their operations by laying off employees. You saw it in all of the big tech names. And they're using that more streamlined capital structure to fund some of the AI spend that they're doing. So this is healthy for the business to do, because that you don't want to be spending, you don't want to be hiring a bunch and also overspending. I like what I see with the efficiency and streamlining of these big tech names. And I think they're cutting out a lot of the fat and trying to streamline it so that they can push it into AI and AI infrastructure. So that gives me a little bit more faith in this type of spending, this high spending in AI. Now, there is an issue that piqued my attention recently, and that is the issue of circular funding. And none of the names that I own are really in it, but OpenAI is pretty much the center of this. And you can see in this chart how this is shaping up. So OpenAI is designating 6 gigawatts of AMD GPUs. AMD gives OpenAI the option to buy up to 160 million shares. This kind of leads to a circular funding chart like this, where one of these things goes down, some of the agreements that are attached to it may go down as well. And that kind of speaks to a bubble. But right now, we're still in the early innings of it. One thing that I chose to avoid in my portfolio, I don't want to be caught up in some type of circular funding bubble here that could be forming. None of my names have been caught in this as of yet, so hopefully it stays that way. And then lastly, the last group that is in my portfolio is the Cyclical Commodities. And this includes Warrior Met Coal and Tidewater. Tidewater is a recent addition to my portfolio. You can watch the video that I did on Tidewater here. So I'll just talk about HCC is a leading met coal producer in the United States. And met coal is just metallurgical coal, which is used to make steel. And that is the predominant way to make steel as of now in this current time. So there's just a slew of tailwinds for HCC. Their project Blue Creek will be completed next year, which they have been spending tons and tons of capex on to finish. Once that's finished in 2026, their free cash flow will jump back up. But not only because of that, their production from Blue Creek overall will increase by 75% or more. So that really increases their free cash flow many, many fold. So because of that increase in free cash flow, they're going to see a big increase in what they can do with that capital. So they could return it to shareholders by special dividends or buybacks. And that's why I have such a strong conviction in HCC right now. And I'm adding to my position right now to make it a larger position in this portfolio. But the main thing I want to say about the cyclical commodities is they are not related to AI whatsoever. So if there is an AI bubble on the horizon in the next 2-3 years, then these names are not going to be part of it. If they do go down because of a bubble pops, it will not be because of their fundamentals. Their fundamentals are very strong. That's why I wanted to have a little bit of more diversification in my portfolio to guard against that potential outcome. So finally, what am I doing with my portfolio? Well, I'm going to get HCC and Amazon up to 20% or higher in the portfolio weighting. And then after I do that, I'm going to increase BABA, ASML, and Tidewater. So those three names I'm going to add and concentrate more after I get HCC and Amazon over 20% of the overall portfolio. And that's it, guys. This was a short video. If you like this content, please like and subscribe, and I will see you guys in the next one.